Welcome to this exam prep review for the Pennsylvania Property and Casualty Insurance exam. We'll unpack why the correct answer stands, why the others fail, and the theory behind each one. We'll complete a full practice set built around insurance principles and terms, personal property coverages, commercial coverage forms, auto policies and coverage, Pennsylvania statutes and rules, and remember everything on our website, from free exam guides to practice questions, is there to help you pass your Pennsylvania Property and Casualty exam with confidence. Just grab the link down in the description below and start studying smarter, not harder today. Good luck out there. Alright, let's get into it. Question 1. A person who has never held an insurance license approaches homeowners at a community event, describes an insurer's policies, and asks each of them to complete an application. Under Pennsylvania's producer licensing article, which Licensable Act best describes that conduct? Your options are A. Negotiating, B. Adjusting, C. Underwriting, D. Soliciting. Which one is it? Pause the video if you need more time. The correct answer is D. Soliciting. D is correct because the licensing article defines soliciting as attempting to sell insurance or asking a person to apply for a particular kind of insurance, which is exactly what the person at the community event was doing. A is wrong because negotiating means conferring directly with a purchaser about the substantive benefits, terms or conditions of a contract. The described conduct never reached that level of discussion about specific policy terms. B is wrong because adjusting refers to investigating and settling claims after a loss has been reported. The activity described here happens before any policy exists, so no claim function is involved. C is wrong because underwriting is the insurer's own evaluation of whether to accept a risk and at what rate. Company employees perform it, and it is not the field activity described in this situation. Pennsylvania licenses whoever stands between an insurer and the public, because that person shapes what the buyer believes was purchased. Long before any claim tests the promise, the law fences off a small set of activities and requires a license for each one. Selling is exchanging a contract for consideration on the insurer's behalf. Negotiating means conferring directly with a buyer about a specific contract's benefits, terms or conditions. Soliciting means attempting to sell or asking someone to apply for a particular insurance from a particular company, and each act alone triggers the license requirement. The clearest test is what the conversation was actually about. Soliciting pushes someone toward the decision to apply, while negotiating works through the substance of the contract itself, like replacement cost versus actual cash value, the deductible, or how an exclusion treats a detached garage. Adjusting and underwriting sit entirely outside this group. Adjusting investigates and settles claims after a loss, while underwriting is the insurer's internal decision to accept a risk. And neither one involves approaching the public to move them toward a purchase. Sorting becomes mechanical once you ask one question: was this person working on someone's decision to buy, the substance of a contract, a claim already filed, or the company's own acceptance decision? Question 2. A Pennsylvania insurer pays its own policyholder for fire damage to her garage under one policy, and under a different policy it pays a neighbor whom the insured injured. Which pair of terms correctly labels these two payments in order? Your options are A. First party and third party, B. Third party and first party, C. Second party and first party, D. Third party and second party. Take a second. Which answer would you pick? The correct answer is A. First party and third party. A is correct because property insurance pays the insured directly and is therefore first party, while liability insurance pays someone outside the contract whom the insured harmed, which makes it a third-party payment. B is wrong because it reverses the two labels. Paying the policyholder for her own damaged garage is the clearest example of a first-party settlement in all of insurance. C is wrong because the second party is the insurer itself. Describing a payment to the insured as a second-party loss confuses who is paying with who is being paid. D is wrong because it misplaces both terms. The insurer is the second party throughout, so it cannot also be the recipient of one of these two payments. One insurer, one fire, two very different checks. To tell them apart, you first need to understand how insurance numbers the parties involved. The numbering counts parties to the contract, not the accident. The first party is the insured who owns the policy. The second party is the insurer who pays. And the third party is an outsider harmed by the insured. Property insurance is first-party coverage, paying the insured for damage to their own things. Liability insurance is third-party coverage, paying or defending against someone the insured injured. A common mistake is calling a payment to the insured a second-party settlement, but the second party writes checks. It never receives them. The distinction shapes everything that follows. First-party claims are settled by the policy's own valuation rules, deductible and appraisal clause, because both sides already have a contract. Third-party claims pull in tort law and a duty to defend, because the outsider has no contract with the insurer at all. Property pays the first party, liability pays the third, and the second party never receives a check. Get that order straight, and any fact pattern about who's owed what becomes easy to read. Question 3. A Pennsylvania insured's covered auto is stolen from a shopping center lot, and she rents a car while the claim is investigated. Which coverage of the personal auto policy reimburses her rental cost, and what condition applies first? Your options are Part A, liability after a police report. B, Part B, medical payments after treatment. C, Part C, uninsured motorists after a denial. D, Part D, transportation expense after waiting. Before I reveal it, which one do you think is right? The correct answer is D, Part D, transportation expense after waiting. D is correct because transportation expense under Part D reimburses temporary transportation costs such as rental cars and fares after a covered loss, and theft claims carry a waiting period before the daily allowance begins. A is wrong because liability coverage pays what the insured owes to others. A stolen vehicle produces no claim by third party, so that part of the policy is never triggered. B is wrong because medical payments funds treatment for bodily injury without regard to fault. Nobody was hurt when the car was taken from the parking lot. C is wrong because uninsured motorist coverage requires an at-fault driver who carries no insurance. A theft involves no negligent motorist at all, so that coverage is never triggered. It's tempting to assume a stolen car's rental reimbursement is a liability issue, since liability is the part of the policy everyone talks about, but that's the trap. Transportation expense actually lives in a completely different part of the policy with its own trigger, waiting period, and caps. The personal auto policy is organized into lettered parts, each solving a different problem. Part A pays for injury or damage the insured causes to others. Part B covers medical costs for the insured and passengers. Part C responds to underinsured at-fault drivers. And Part D covers damage to the insured's own vehicle, which is exactly where transportation expense belongs. Coverage doesn't start the moment a theft is reported. A waiting period, commonly 48 hours, must pass first, and reimbursement then continues daily up to a cap, until the insurer pays the claim or the car is returned and repaired. That delay isn't arbitrary. Most reported thefts are recovered within a day or two, so paying rental costs immediately would fund countless rentals for cars that were coming back anyway. The waiting period screens out quick recoveries and reserves the benefit for genuine losses of use. Part A protects other people from the insured. Parts B and C protect people inside the car, and Part D protects the vehicle itself and the consequences of losing its use. Any mention of a stolen vehicle, a rental, or a waiting period should point you straight to Part D. Question 4. A Pennsylvania machine shop ships a product to a customer in Ontario, and an injury there produces a claim against the shop. The shop asks whether its commercial general liability policy reaches that claim. Which statement describes the coverage territory? Your options are A. The United States only. B. Any country where the product is sold. C. The United States, Puerto Rico, and Canada. D. Only the state shown on the declarations. What's your answer? Commit to one before I continue. The correct answer is C. The United States, Puerto Rico, and Canada. C is correct because the coverage territory includes the United States, its territories and possessions, Puerto Rico and Canada, with a limited worldwide extension for certain products and for the activities of a traveling insured. A is wrong because the territory has never been that narrow. Excluding Canada would leave manufacturers near the northern border without protection on a large share of their shipments. B is wrong because the form does not follow a product everywhere it may travel. The main territory is defined geographically and broader protection requires a specific extension. D is wrong because the declarations identify where the insured operates rather than confining coverage to that state. A liability policy limited to one state would be nearly useless commercially. The commercial general liability policy defines coverage territory in 2 tiers, and that definition reaches further than its name suggests. Let's break down how it actually works. The first tier is simple: the United States and its territories and possessions, Puerto Rico and Canada. Injury or damage happening in any of these places is inside the territory, no further analysis needed. Coverage also extends worldwide when injury arises from products made or sold in the listed territory, from an employee traveling on business, or from certain internet activity. But there's a catch. The insured's liability must be decided in a suit brought within the listed territory, or in a settlement the insurer agrees to. Picture a Pennsylvania machine shop shipping the same component 2 different ways. Sent to Ontario, an injury there falls inside the listed territory automatically. Sent to Germany, the worldwide extension can reach the claim, but only if suit is brought back in the listed territory. The territory definition really answers 2 separate questions. Inside the listed territory, only where the injury happened matters. Outside it, coverage survives only if liability comes home to be decided there. Question 5. A diligent Pennsylvania producer finishes 40 credit hours during a 2-year license period, well beyond what the statute requires. What does the continuing education law allow him to do with the credits he earned above the minimum? Your options are A. Nothing, since excess credits expire. B. Convert them into a fee waiver. C. Apply them to another line of authority. D. Carry forward up to 24 hours. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Carry forward up to 24 hours. D is correct because the statute permits excess credits to carry forward into the next license period, capped at a maximum of 24 hours. So a producer who works ahead can bank a full period's worth of credit. A is wrong because a strict use it or lose it rule would punish the producer who studies early. Pennsylvania chose the opposite approach and gives surplus hours a defined life beyond the period earned. B is wrong because education credits and licensing fees run on separate tracks. Completing extra coursework does not reduce or replace the renewal fee a producer owes the department. C is wrong because the hour requirement is not divided line by line. Excess credits are handled through the carry-forward rule rather than being reassigned to satisfy a separate authority. Pennsylvania continuing education runs on a fixed 2-year license cycle, and the carry-forward rule exists because producers often finish that cycle with more hours than the law required. Producers who attend conferences, complete designation programs, or work through employer training often finish a license period well beyond the required hours, and without a carry-forward rule, all of that surplus would simply vanish when the period closed. Take a producer who earns 40 credit hours in one period. The surplus above the requirement carries into the next period, but only up to a maximum of 24 hours, and anything beyond that ceiling simply disappears. Several conditions travel with this rule. Carried hours move only into the immediately following period. Courses must be department approved. Certain producers are exempt entirely, and subject-specific requirements must still be met within the period itself, not through carried credit. The 24-hour ceiling is the whole point. It rewards producers who do more than the minimum, while stopping unlimited banking from letting anyone coast through future cycles without touching fresh material. Question 6. A Pennsylvania homeowner wants a policy that insures her owner-occupied house and her personal property against a defined list of causes of loss rather than on an open peril basis. Which homeowner's form matches that description best? Your options are A. The special form, B. The comprehensive form, C. The broad form, D. The contents broad form. Which would you go with? Lock it in before the reveal. The correct answer is C. The broad form. C is correct because the broad form ensures an owner-occupied dwelling and personal property against a named list of perils, which places it a step below the special and comprehensive forms in breadth of coverage. A is wrong because that form gives the dwelling and other structures open peril treatment while leaving contents on the broad list. The homeowner asked for named perils throughout. B is wrong because that form extends open peril coverage to both the building and the personal property. It is the widest option in the program and the opposite of what she requested. D is wrong because that form is written for tenants and insures no building at all. A homeowner who owns her dwelling needs building coverage the tenant form never provides. Homeowners' policies grew out of separate fire, theft, and liability forms that got bundled into one package, which forced insurers to answer a core design question: how should covered causes of loss be described? A named peril approach lists the causes covered and anything left off isn't covered. An open peril approach, once called all risk, covers everything except what's specifically excluded. The real difference is who carries the burden of proof. Under named peril, the insured proves the cause. Under open peril, the insurer must find an exclusion to deny the claim. The broad form insures both dwelling and personal property on a named peril basis, but with an expanded list: falling objects, weight of ice and snow, accidental discharge of water or steam, freezing, sudden tearing apart of a heating or air conditioning system, and damage from artificially generated electrical current. The middle of market form covers the dwelling on an open peril basis, but leaves personal property on named peril, while the broad form treats both alike under its expanded list. In Pennsylvania, weight of ice and snow and freezing pipes make this distinction genuinely practical, not just theoretical. When a scenario describes what a homeowner wants rather than naming a form, listen for whether dwelling and contents are treated the same way, and whether losses are defined by a list or by exclusions. That's the translation these questions expect. Question 7. A Pennsylvania collector owns several valuable violins that far exceed the special limits in her homeowner's policy. She wants coverage listing each instrument, insuring them against open perils worldwide with no deductible. Which personal lines approach fits that request? Your options are A. Scheduling the items on a floater. B. Increasing the coverage C limit. C. Adding a water and sewer backup endorsement. D. Buying an umbrella policy. Don't overthink it. Which one feels right? The correct answer is A. Scheduling the items on a floater. A is correct because a personal articles form or scheduled personal property endorsement lists items individually, insures them against open perils on a worldwide basis, and is usually written with no deductible applying. B is wrong because raising the overall contents limit leaves the special theft caps and the name peril treatment in place. The instruments would still be limited in ways scheduling avoids. C is wrong because that endorsement addresses water backing up through sewers and drains into the dwelling. It solves a specific water problem rather than protecting valuable articles. D is wrong because an umbrella provides excess and broadened liability protection. It responds to claims by injured third parties and never insures the insured's own possessions. A homeowner's policy seems to cover everything you own, but valuable items like a fine violin often hide in the gaps of that coverage. A standard policy handles personal property on a blanket basis, but categories like jewelry, watches and furs, silverware, firearms, and money and securities sit under special limits far below the total. These caps exist because a few small, easily stolen, hard-to-value items would otherwise dominate the losses of a policy priced for ordinary furniture and clothing. Scheduling an item reverses the treatment entirely. It's covered on an open peril basis instead of named perils. Coverage follows the item worldwide instead of staying at the residence. And it's commonly written with no deductible. Under a scheduled personal property endorsement, each item is listed individually with its own agreed amount, backed by an appraisal or bill of sale, pulling it out of the anonymous blanket pool entirely. Raising the overall contents limit just gives more of the same named peril coverage with the same special limits. Scheduling gives something different, individually valued, open peril, worldwide, and often deductible free. Question 8. An underwriter inspecting a Pennsylvania warehouse notes an obstructed sprinkler head, a badly worn electrical panel and stairs missing a handrail. All three conditions increase the chance of a loss. Which type of hazard do these observations represent? Your options are A. Moral hazard, B. Morale hazard, C. Legal hazard, D. Physical hazard. Got a guess? Lock it in. The correct answer is D. Physical hazard. D is correct because a physical hazard is a tangible condition of the property or its use that increases the chance or severity of loss, and every item the underwriter recorded is something visible on inspection. A is wrong because a moral hazard involves dishonesty, the willingness to cause or exaggerate a loss for financial gain. Nothing in the inspection report speaks to the owner's character. B is wrong because a morale hazard is an attitude of carelessness or indifference toward loss. It describes how someone behaves rather than a defect an inspector can photograph. C is wrong because a legal hazard arises from the legal environment, such as court trends or statutes that enlarge losses. A worn electrical panel raises no question of law. Underwriters draw a sharp line between peril and hazard. A peril is the cause of loss itself, like fire, windstorm, theft, or collision. A hazard is a condition or behavior that makes a peril more likely or a loss more severe, which is why oily rags beside a furnace matter even though fire is the actual peril. Hazard sort into recognized categories. Physical hazard is a tangible condition of the property or operation. Moral hazard is dishonesty, a willingness to cause or profit from a loss. Morale hazard is carelessness that grows once insurance is in place, and none of these three is the peril itself. The line most often blurred is between moral and moral hazard, and the cleanest test is intent. Moral hazard involves dishonesty and a desire for the loss to occur. Moral hazard involves indifference, like an insured who stops lock in the warehouse simply because theft coverage exists. Both are attitudes of a person, never a condition of a building. Picture an inspection at a warehouse outside Harrisburg. The inspector finds pallets blocking sprinkler discharge, an electrical panel with scorched insulation, and a staircase with no handrail. Each is a tangible condition, nothing about trust or carelessness, and that tangibility is exactly what defines physical hazard. One question sorts every case. Is the described thing something an inspector could photograph, something dishonest, or something careless? Physical hazards drive underwriting because they can be inspected, corrected, and verified, while moral and moral hazards are managed instead through policy conditions and declination. Question 9. A Pennsylvania insured moves valuable stock out of a threatened building to a nearby storage unit after a fire begins next door. The stock is damaged at the storage unit. How does the building and personal property coverage form respond? Your options are: A. It covers loss shortly after removal. B. It denies the loss entirely. C. It covers only if the building burned. D. It covers with no time limit. Which one is it? Pause the video if you need more time. The correct answer is A. It covers loss shortly after removal. A is correct because the preservation of property additional coverage pays for loss to property removed from the premises to protect it from a covered peril, provided the loss occurs within a limited number of days after removal. B is wrong because the form anticipates that an insured will move property to save it. Penalizing that decision would discourage exactly the conduct the policy wants to encourage. C is wrong because the coverage turns on the threat that prompted the removal rather than on the eventual fate of the original building. Prudent action is protected either way. D is wrong because open-ended protection would eventually insure property at a second location the insurer never underwrote. The form closes the window after a short period. Standard insurance covers property that's already damaged. But what happens to goods moved out of harm's way before disaster strikes? That question created a real gap in early property insurance. Picture an insured watching fire approach a warehouse, forced to choose between leaving goods put or moving them and risking coverage. The removal provision resolves this by insuring property against loss from any cause while it's being moved and temporarily stored elsewhere. Two features run broader than the underlying policy. While removed, property is covered against any cause of loss, not just the causes listed in the form. And coverage travels to a location never described or rated. But two limits keep it in check: a time limit, usually 30 days, and the fact that removal coverage draws from the existing policy limit rather than adding extra funds. Consider a plating shop near Reading. Fire breaks out next door, so staff carry finished stock to a rented storage unit 2 blocks away. 3 days later, a sprinkler failure at that unit soaks the stock, and the policy still responds, because the move was triggered by a covered cause, fell within the time period, and the goods were covered against any cause while removed. The triggering requirement matters most. Removal must preserve property from a covered cause of loss, not convenience, renovation, or a sale. Understanding removal coverage means recognizing its time limited, broader than the underlying causes, and drawn from the existing policy limit. Question 10. After a hearing, the Commissioner finds that a Pennsylvania producer violated the licensing article on 4 separate occasions. Apart from suspending or revoking the license, what is the maximum civil penalty the Commissioner may impose for each violation? Your options are A. $1,000, B. $10,000, C. $5,000, D. $25,000. Take a second. Which answer would you pick? The correct answer is C. $5,000. C is correct because the disciplinary section lets the commissioner impose a civil penalty of up to $5,000 for each violation of the Act, and that penalty may be combined with license action and a cease and desist order. A is wrong because $1,000 per act is the ceiling under the Unfair Practices Statute for violations the person did not know were violations. That figure belongs to a different penalty scheme. B is wrong because $10,000 matches the penalty for violating a cease and desist order under the Unfair Practices Law. Importing it into the licensing article doubles the authorized amount. D is wrong because no provision of the licensing article reaches that high on a per violation basis. Large totals arise by multiplying violations, not by raising the individual ceiling. Insurance regulators don't just have one tool. They have layered enforcement powers, ranging from money penalties to taking away a license entirely. And understanding why both exist is the key to this topic. License revocation is reserved for the worst conduct, so a graduated system exists alongside it. After a hearing, the commissioner may suspend or revoke a license, order restitution, and impose a civil penalty all at once, since none of these remedies cancel each other out. The $5,000 civil penalty cap applies separately to each violation, not once per proceeding. 4 violations mean the ceiling is applied 4 times, for a maximum exposure of $20,000. If the cap applied per proceeding instead of per violation, 1 incident and 40 incidents would cost the same, making every violation after the first effectively free. Counting each violation separately keeps the penalty proportionate to the real scope of misconduct. Restitution and civil penalties serve different purposes. Restitution makes the client whole, while the penalty punishes the misconduct itself. Always read a penalty provision for 2 things: the dollar amount and the unit it attaches to, because missing the unit is the error that trips people up. Question 11. A Pennsylvania landlord carries a dwelling special form on a rental house. A tenant reports that someone stole a refrigerator the landlord had supplied. The landlord assumed open peril coverage would pay. How does the special form respond to that particular loss? Your options are: A. It excludes theft from the special form. B. It pays because coverage is open peril. C. It pays half after depreciation. D. It pays only for the dwelling structure. Before I reveal it, which one do you think is right? The correct answer is A. It excludes theft from the special form. A is correct because the dwelling special form insures the dwelling and other structures against risks of direct physical loss except those excluded. And theft is one of the causes of loss the form expressly removes. B is wrong because open peril treatment operates only until an exclusion applies. Theft sits on the exclusion list, which is why the dwelling program sells a separate theft endorsement. C is wrong because partial payment is not how an exclusion works. The form either responds to a cause of loss or it does not. And depreciation affects valuation rather than coverage. D is wrong because coverage C is available for the owner's own personal property at the location. The obstacle here is the cause of loss rather than the category of property. Open peril coverage sounds like it protects against nearly everything, but the dwelling special form quietly excludes one major risk: theft. Landlords often discover this gap only after something goes missing. The dwelling program exists for rental houses, seasonal properties, and investment homes that don't fit a homeowner's policy. It offers a graduated set of forms, moving from a narrow named peril version up to the special form, which converts property coverage to an open peril basis. In a homeowner's policy, the insured lives in the home and controls who has access, so theft is covered. In a rental dwelling, the owner is often absent, cannot control who holds keys, and theft losses become hard to investigate or verify, which is why the special form removes theft as a moral hazard control. This pattern extends far beyond theft. Reading an open peril form means reading its exclusion list, and standard removals include wear and tear, inherent vice, faulty workmanship, settling, insect damage, and losses from the insured's own neglect. Where the insured occupies and controls the property, theft coverage comes standard. Where the owner is absent, theft coverage is something that must be bought back by endorsement, and open peril never meant unlimited. Question 12. A Pennsylvania worker injured on the job needs surgery. Months of physical therapy and follow-up treatment stretching past a year. He asks whether his medical benefits will run out. Which statement correctly describes medical benefits under the Pennsylvania Workers' Compensation Act? Your options are: A. They stop after 104 weeks. B. They have no dollar or time cap. C. They stop after 500 weeks. D. They stop when wage loss benefits end. What's your answer? Commit to one before I continue. The correct answer is B. They have no dollar or time cap. B is correct because the Act provides all reasonable and necessary medical services with no dollar limit and no time limit, with payment made under a fee schedule keyed to Medicare-based rates. A is wrong because that figure marks when an insurer may first request an impairment rating evaluation on a totally disabled worker. It measures a wage loss milestone rather than medical coverage. C is wrong because that number caps partial disability payments under the Act. Wage replacement and medical treatment run on entirely separate tracks under the Pennsylvania statute. D is wrong because a worker who returns to full duty may still need continuing treatment. Tying medical care to income benefits would cut off treatment precisely when recovery is progressing. Before workers' compensation, injured workers had to sue their employer for negligence, and that path almost always failed. Employers relied on three defenses: assumption of risk, the fellow servant rule, and contributory negligence. So injured workers went uncompensated while employers still occasionally faced ruinous verdicts. These three common law defenses closed off recovery almost every time, leaving both workers and employers with reason to want a different system. Pennsylvania's early 20th century compromise traded rights on both sides. Workers surrendered the right to sue and to claim pain and suffering, gaining benefits regardless of fault. Employers surrendered their defenses and accepted liability for every injury, gaining predictable, insurable costs and immunity from tort suits. Wage loss, specific loss, and death benefits all follow schedules with caps on amount or duration. Medical benefits work differently. There is no dollar limit and no time limit. So treatment continues as long as it remains reasonable, necessary, and causally related to the injury. Cost control works by capping what providers can charge and reviewing whether treatment is appropriate, not by limiting what an injured worker can receive. A serious injury never triggers a letter saying medical benefits ran out. So any question about exhaustion or duration past a year points straight to medical benefits being unlimited. Question 13. A Pennsylvania insurer decides to end a commercial policy in the middle of its term, and on a second account it decides to let the policy simply run to its expiration date and not offer new terms. Which pair of terms describes these two actions? Your options are: A. Rescission and reformation, B. Non-renewal and cancellation, C. Lapse and reinstatement, D. Cancellation and non-renewal. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. cancellation and non-renewal. D is correct because cancellation ends a policy before its expiration date and requires advance notice from the insurer, while non-renewal occurs at the expiration date when the insurer declines to write another term. A is wrong because rescission voids a contract from inception, usually for misrepresentation, and reformation rewrites wording to reflect what the parties intended. Neither describes an ordinary termination. B is wrong because it reverses the two terms. Ending coverage midterm is by definition the action that happens before the expiration date on the declarations arrives. C is wrong because lapse describes coverage ending for non-payment and reinstatement describes bringing it back. Those terms belong mainly to the life and health side of the business. Ending a policy is not one action but two, and the difference between them comes down to timing. Cancellation ends a policy before its expiration date, cutting the contract short while it's still running. Non-renewal happens at the expiration date when the insurer simply declines to offer another term. Both end the relationship, but only one interferes with a policy period the insured has already paid for and relied upon. That difference drives everything else, including how tightly each one is regulated. Because midterm cancellation is more disruptive, states restrict it tightly. After the initial period, insurers generally may only cancel for non-payment of premium, material misrepresentation, or a substantial change in risk, and they must give advance written notice. The initial policy period, commonly the first 60 days, is where the general rule bends. Underwriting isn't truly completed binding, so inspections and reports still need time to arrive before the tighter mid-term restrictions lock in. Reading the timing carefully separates these cleanly. Cutting a policy short mid-term is cancellation, while letting it run to expiration and declining new terms is non-renewal. When a question gives you a pair, the order it describes is the order to trust. Question 14. A Pennsylvania driver with several at-fault accidents cannot find any insurer willing to write his automobile liability coverage in the ordinary market. Which mechanism does the Motor Vehicle Financial Responsibility Law direct the insurance department to maintain for drivers in his position? Your options are A. The FAIR Plan, B. The Guarantee Association, C. An Assigned Risk Plan, D. A surplus lines placement. Which would you go with? Lock it in before the reveal. The correct answer is C. An assigned risk plan. C is correct because the department must adopt an assigned risk plan for applicants entitled to but unable to procure insurance through ordinary methods, and every motor vehicle liability insurer must subscribe and participate. A is wrong because that plan assures the availability of basic property insurance in urban areas. It insures buildings against fire and related perils rather than covering drivers. B is wrong because that association pays covered claims after a licensed insurer becomes insolvent. It is a safety net for existing claims rather than a source of new coverage. D is wrong because surplus lines placement requires a diligent search of the admitted market and is aimed at unusual commercial exposures. Ordinary drivers are routed to the residual plane instead. Compulsory insurance laws create a problem they can't solve alone. They force every driver to buy coverage, but insurers can still refuse to sell it to risky drivers. Something has to close that circle. Residual market mechanisms appear anywhere coverage is mandated, but the voluntary market won't cooperate. Assigned risk plans handle auto liability. Fair access plans handle property in high-risk areas. And assigned risk pools handle workers' compensation. In every case, the market's own participants are conscripted to absorb what they'd otherwise reject. The allocation formula is what makes this sustainable. Assignments are distributed in proportion to each insurer's voluntary market share, so a company writing more Pennsylvania business takes on a proportionally larger share of the assigned risks. This ties the burden directly to the benefit, so no carrier can grow profitably while dumping the hard cases on smaller competitors. Coverage through the plan is intentionally unattractive by design. Rates run higher, coverage is often capped at mandatory minimums, and eligibility only extends to drivers entitled to insurance but unable to get it, not to those disqualified outright, like unlicensed drivers or those with unpaid premiums. The assigned risk plan is the exchange that makes a compulsory insurance law actually enforceable. Insurers get the privilege of writing business in Pennsylvania, and in return they accept a proportional share of the drivers nobody else wants. Question 15. The Commissioner intends to hold a formal hearing on whether to revoke a Pennsylvania producer's license after an investigation. Under the disciplinary section, what does the producer receive before that hearing takes place, and how far in advance? Your options are A. A consent agreement offer 7 days ahead. B. An investigative report 5 days ahead. C. A cease and desist order immediately. D. A hearing notice at least 10 days. Don't overthink it. Which one feels right? The correct answer is D. A hearing notice at least 10 days. D is correct because the section requires notice fixing a hearing at least 10 days out before the Commissioner may impose license discipline, which gives the producer time to prepare a defense under the formal hearing rules. A is wrong because consent agreements resolve enforcement matters by settlement rather than functioning as pre-hearing notice. Many cases end that way, but no statute entitles a licensee to an offer beforehand. B is wrong because the statute does not promise advance delivery of the department's investigative file. What it guarantees is timely notice of the proceeding itself so the licensee can appear and respond. C is wrong because A, cease and desist order is one of the outcomes available after the process runs, not a document handed over in advance. Issuing it first would reverse the order of operations. A license is a livelihood, and taking it away requires more than a decision behind closed doors. Because agencies hold real power to discipline, procedure exists as the counterweight, and that procedure begins with notice. Due process reduces to two requirements found throughout regulatory law: notice and an opportunity to be heard. Notice means knowing what conduct is at issue and when it will be decided, while opportunity to be heard means a genuine chance to present evidence, cross-examine witnesses, and argue before any decision is made. Pennsylvania's disciplinary section builds this directly into the law. Before suspending, revoking, or refusing to renew a license, the producer must receive notice fixing a hearing at least 10 days out. That advance interval is the operative term, giving time to gather records and counsel before the public interest in a timely resolution takes over. The protection extends beyond notice itself. Formal hearing rules let the producer examine evidence and build a record, and that record is what supports any later appeal. Without a hearing, there's no record, and without a record, meaningful review is impossible. The pattern to carry forward is simple. Regulatory authority almost always arrives bundled with procedure. Reading a disciplinary statute means reading the power and the process side by side, because process is what makes power lawful. Question 16. A Pennsylvania consulting firm owns no vehicles but frequently rents cars for client visits and wants liability coverage that applies to those rentals. Which covered auto symbol on the business auto coverage form addresses that exposure most specifically? Your options are A. Symbol 1, B. Symbol 7, C. Symbol 8, D. Symbol 9. Got a guess? Lock it in. The correct answer is C. Symbol 8. C is correct because symbol 8 designates hired autos, meaning vehicles the insured leases, hires, rents, or borrows, which is exactly the exposure a firm creates when it rents cars for business travel. A is wrong because that symbol reaches any auto and would provide far broader coverage than the firm asked about. It is the widest designation the form offers. B is wrong because that symbol limits coverage to the specifically described autos listed on the declarations. A firm that owns no vehicles would have nothing at all to schedule. D is wrong because that symbol covers non-owned autos, typically employees' personal cars used on company business. Rented vehicles are a separate category with their own symbol. A firm that owns 0 vehicles can still have a massive auto exposure. Think of consultants who rent cars at every client site. Business auto policies handle this not by listing vehicles, but through a symbol system. And understanding how those symbols work matters far more than memorizing any single number. Rather than listing individual vehicles, the form assigns a symbol to each coverage on the declarations page. Each symbol defines a category of autos. So one policy can cover one group of vehicles for liability and an entirely different group for physical damage. Symbol 8 designates hired autos, vehicles the insured leases, hires, rents, or borrows, which matches a consulting firm's rental exposure exactly. Symbol 9 designates non-owned autos, covering vehicles owned by employees or partners and used for company business. Symbol 1, any auto, would technically work too, but it reaches far more exposure than the firm actually has. There's an important carve-out. A car rented or borrowed from an employee's or partner's household doesn't count as hired. It shifts to the non-owned category. This line exists, so a business can't turn personal vehicles into hired autos through paperwork just to get broader coverage. Every symbol scenario boils down to 2 questions. Does the insured own the vehicle? And if not, who does and under what arrangement? Answer those and the right symbol follows every time. Question 17. A Pennsylvania bakery is sued after a customer is injured by a foreign object baked into a loaf sold last month. The insurer must decide which definition in the commercial general liability policy governs the claim. Which definition applies here? Your options are your product, B, your work, C, mobile equipment, D, impaired property. Which one is it? Pause the video if you need more time. The correct answer is A, your product. A is correct because your product means goods manufactured, sold, handled, distributed, or disposed of by the insured, including containers and warranties. And a loaf of bread sold to a customer fits that definition squarely. B is wrong because that definition covers work or operations performed by or on behalf of the insured, along with materials supplied for that work. Selling a finished loaf is not performing services. C is wrong because that definition addresses vehicles designed principally for use off public roads, such as bulldozers and forklifts. It has no application to a food item. D is wrong because that definition concerns tangible property that cannot be used because it incorporates the insured's defective work. The customer's injury is bodily injury rather than lost use of property. In a CGL policy, quoted terms aren't casual language choices. Every word in quotation marks has a specific definition buried in the policy. And that definition, not common sense, decides who gets paid. Products liability covers goods manufactured, sold, handled, distributed, or disposed of by the named insured, by others trading under its name, or by a business it acquired. It also reaches containers, materials, and any warranties made about the product. The sharpest test in this area is keeping 2 definitions apart. Products liability attaches to something tangible that left the insured's hands, while completed operations liability attaches to work performed at someone else's location. A loaf of bread sold is a product, but installing an oven in that kitchen is work. 3 Qs sort every case. A product that left the premises and later injures someone points to product's liability. Work performed at a customer's site pointing to completed operations. And an injury happening on the insured's own premises during ongoing activity points to premises and operations. Remember the exclusion running alongside all of this. The policy pays for injury the product causes, never for replacing the defective product itself. The bread that hurts someone is covered, but the loaf itself is just a business loss. Question 18. An applicant submits a completed application and the first premium for commercial property coverage. The insurer responds that it will issue a policy only at a higher premium with an added exclusion. Which contract concept describes the insurer's response? Your options are A. An acceptance, B. A counteroffer, C. Consideration, D. A warranty. Take a second. Which answer would you pick? The correct answer is B. A counteroffer. B is correct because when the insurer responds with different terms rather than agreeing to the application as submitted, it makes a counteroffer and the applicant may then accept those conditions or withdraw the application. A is wrong because acceptance means agreeing to the offer as it stands. Changing the premium and adding an exclusion alters the terms, which prevents a meeting of the minds on the original offer. C is wrong because consideration is the value each party contributes, meaning the premium and statements on one side and the promise to pay on the other. It does not describe a response to an offer. D is wrong because a warranty is a promise that something is or will be true, and breaching it may void the contract. No such promise is being made in the insurer's reply. An insurance policy is a contract, and contracts require an offer, acceptance without changes, consideration, legal capacity, and a lawful purpose in sequence. Miss any element and there's no contract. Insurance dresses this up in its own vocabulary, but the exam is really testing ordinary contract law. Who makes the offer depends on what came with the application. Submit the application with premium, and the applicant is offering, with premium as consideration. The insurer accepts by issuing the policy as applied for. Submit without premium, and the roles flip. The insurer offers by issuing a policy, and the applicant accepts by paying. Acceptance must mirror the offer exactly, with no additions, deletions, or changes. A response that alters any material term isn't an acceptance at all. It's a counter-offer that kills the original offer and hands the power to accept or refuse back to the applicant. Nothing revives that original offer later. Underwriters issue counter-offers routinely, charging a higher premium, adding an exclusion, requiring a safeguard, or imposing a higher deductible are all standard responses. And each one changes a term the applicant proposed, making it a counter-offer rather than an acceptance. A conditional receipt providing interim coverage doesn't change this. It never turns a counter-offer into acceptance. Compare what was asked for against what the insurer returned. Identical terms complete a contract. Different terms restart the process with the roles reversed. Question 19. A Pennsylvania homeowner's wallet is stolen and the thief runs up charges on her credit cards, while a forged check also clears her account. She asks whether her homeowner's policy helps. Which additional coverage responds to these losses? Your options are A. Loss assessment coverage, B. Damage to property of others, C. Credit card, forgery and counterfeit money coverage, D. Ordinance or law coverage. Before I reveal it, which one do you think is right? The correct answer is C. Credit card, forgery and counterfeit money coverage. C is correct because the homeowner's forms include an additional coverage for unauthorized use of credit cards, forgery or alteration of instruments, and acceptance of counterfeit money, subject to a modest limit with no deductible. A is wrong because that coverage pays the insured's share of a charge levied by a property owners association. No association is involved in a stolen wallet. B is wrong because that coverage pays for property the insured damages without regard to legal liability. Here the insured is the victim rather than the person causing harm. D is wrong because that coverage funds the increased cost of rebuilding to current codes after a covered loss. Nothing about the house needs to be reconstructed. A stolen wallet leads to fraudulent charges and a forged check. The wallet itself is nearly worthless, but the financial damage is enormous, and it doesn't fit the way homeowners insurance normally works. The core of a homeowner's policy pays for direct physical loss to tangible things. A stolen television is easy to handle because a physical object is gone, but a stolen credit card number destroys no physical property at all. It just creates a financial obligation in the insured's name. Homeowners forms close this gap with one additional coverage grouping 3 related exposures: unauthorized use of credit cards, forgery or alteration of instruments, and acceptance of counterfeit money in good faith. In each case, someone else's dishonesty causes a financial loss without any property being damaged. This sits in a distinct category of the policy. It is not a sublimit of the personal property coverage, but a separate grant with its own modest limit, generally provided without a deductible. Removing the deductible makes the coverage functional, since most losses of this kind are too small to survive a standard property deductible. The trade-off is a low limit, which is what keeps a first dollar coverage affordable. Homeowners coverage answers 2 different kinds of harm in 2 different ways. Damage to things runs through the main property coverages, while financial loss from another person's dishonesty runs through the small, deductible-free additional coverage. Question 20. A Pennsylvania insurer is redesigning its homeowner's application and its claim forms and asks which documents must carry the state's fraud warning. Which statement correctly describes the fraud warning language that Pennsylvania law requires those documents to carry? Your options are: A. Only claim forms. B. Only commercial applications. C. It is optional. D. All applications and all claim forms. What's your answer? Commit to one before I continue. The correct answer is D. All applications and all claim forms. D is correct because the statute requires the prescribed fraud warning on all applications for insurance and all claim forms, telling the reader that a materially false statement is a fraudulent insurance act subject to criminal and civil penalties. A is wrong because leaving applications out would remove the warning from the very document where misstatements about the risk begin. Pennsylvania places the notice at both ends of the transaction. B is wrong because the requirement is not limited to any class of business. Personal lines applicants see the same warning and no exemption turns on whether the risk is commercial. C is wrong because the statute prescribes the language rather than inviting alternatives. Allowing each insurer to write its own version would defeat the purpose of a uniform, recognizable notice. Insurance fraud raises costs for everyone because losses paid on fake claims come from the same premium pool that pays legitimate ones. Since insurers can't investigate every statement, states fight fraud at the point where false statements enter the system. The fraud warning itself is preventive, not punitive. It tells a person at the moment of writing that a materially false statement is a fraudulent insurance act subject to criminal and civil penalties, hoping to stop the marginal case before it becomes a claim to investigate. Pennsylvania requires the warning on 2 categories of documents: applications for insurance and claim forms. Application fraud corrupts the underwriting decision itself, while claim fraud extracts money the policy never owed. Both ends of the transaction are covered because both cause real harm. The word materially carries the weight in this warning. A statement is material only if it would affect the insurer's decision on accepting the risk, setting the premium, or paying the claim. A misspelled street name is a paperwork error. Concealing a prior fire loss is a fraudulent insurance act. Fraud regulation covers the whole life cycle of a policy, entry and exit alike, backed by both criminal penalties and civil remedies like voiding a policy or denying a claim. The rule to hold on to: every application and every claim form must carry the fraud warning. Question 21. A covered fire at a Pennsylvania plating shop releases chemicals that soak into the soil, and the borough orders the insured to remove the contaminated earth. Which statement describes the pollutant cleanup coverage under the building and personal property coverage form? Your options are: A. Limited with a reporting deadline. B. Unlimited when a covered peril applies. C. Available only by separate endorsement. D. Excluded when a government orders it. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Limited with a reporting deadline. A is correct because the pollutant cleanup and removal additional coverage pays to extract pollutants from land or water at the premises when a covered cause of loss produced the pollution, subject to a stated limit and a reporting deadline. B is wrong because environmental remediation can cost far more than the property itself. The form deliberately caps the amount, so the exposure remains something an insurer can price. C is wrong because the protection is built into the form as an additional coverage. Businesses with serious pollution exposure buy separate environmental policies for amounts beyond it. D is wrong because a cleanup order is the ordinary way this expense arises, excluding losses simply because a regulator directed the work would leave the coverage with nothing to pay. Broad pollution exclusion solved one problem for insurers but created another. An ordinary covered fire could leave an insured holding a cleanup bill. The pollutant cleanup and removal coverage is the narrow carve back written to fix exactly that unfairness. The causation requirement is the first gate. The pollution must result from a covered cause of loss, not gradual seepage, a failing tank, or routine operations. Two limits keep the grant small: a modest stated limit, commonly $10,000, and a strict reporting deadline, commonly 180 days. The reporting deadline exists because environmental claims have a long tail. Forcing the report within months keeps the investigation contemporaneous, while the event is still documented and the site can still be examined. Picture a plating shop where a covered fire ruptures containers and chemicals soak into the soil behind the building. Because a covered cause of loss produced the contamination, the coverage responds, but only up to the stated limit and only if reported in time. This coverage is conditioned on a covered cause capped at a modest amount and forfeited entirely by late reporting. An insured with real environmental exposure still needs a separate pollution policy, and saying so plainly is what good advice looks like. Question 22. A Pennsylvania insured owns a 22-foot powerboat with a trailer, and a neighbor owns a 30-foot sailing vessel with a cabin and an inboard engine. Which policy is written for the neighbor's larger sailing vessel? Your options are a boat owner's policy, B. a yacht policy, C. a personal articles floater, D. a dwelling policy endorsement. Which would you go with? Lock it in before the reveal. The correct answer is B. a yacht policy. B is correct because yacht policies serve vessels of 26 feet or more, ensuring the hull, the trailer and protection and indemnity liability, while boat owners' policies handle smaller craft under that length. A is wrong because that form is written for smaller craft covering the boat, motor and trailer for an owner of a modest powerboat. A 30-foot vessel exceeds its intended range. C is wrong because that form schedules valuable articles such as jewelry, Furs and fine art against open perils. Watercraft are handled through their own policies rather than as scheduled items. D is wrong because homeowners and dwelling forms carry only small watercraft limits and exclude larger vessels from liability coverage. A cabin sailboat needs a policy built for the water. Watercraft coverage splits along a single dividing line drawn at 26 feet. Below it, you're in the boat owner's market. At or above it, you're in the yacht market. Written on ocean marine forms with an entirely different structure and posture. The industry splits at length because length correlates with how a vessel is actually used. Smaller craft are trailered, launched, and stored at home while larger vessels stay in the water at a marina, carry inboard propulsion, have accommodations, and travel farther from shore, changing the perils, crew exposure, salvage picture, and liability regime. The yacht policy reflects its ocean marine heritage in its structure. Hull coverage ensures the vessel and trailer on an agreed value basis, while protection and indemnity covers maritime liability exposures like crew injury, damage to other vessels or docks, wreck removal and fuel pollution, exposures that ordinary premises liability was never built to handle. Yacht policies carry conditions rooted in maritime tradition. Navigational limits define where the vessel is covered. A layup warranty requires storage during an off-season, and seaworthiness obligations require the owner to keep the vessel fit, and breaching any of these can defeat a claim. A vessel at or above yacht length with a cabin, inboard propulsion, or marina berthing points to a yacht policy, while a trailered outboard craft points to boat owner's coverage. Reading the length first is the fastest route, and the vessel's other details almost always confirm it. Question 23. A Pennsylvania distributor insures inventory at 4 warehouses under one limit that applies to all locations combined, rather than a separate stated amount at each site. Which method of writing property coverage does this arrangement represent for the account? Your options are A. Blanket insurance, B. Specific insurance, C. Scheduled insurance, D. Reporting form insurance. Don't overthink it. Which one feels right? The correct answer is A. Blanket insurance. A is correct because blanket insurance applies a single limit across all covered property or all covered locations without breaking the amount down, item by item, which suits a business whose values shift between sites. B is wrong because that approach assigns a stated amount to one item or one location. A distributor moving stock among warehouses would risk being underinsured wherever inventory happened to pile up. C is wrong because that approach lists property individually with a limit beside each entry. It offers precision at the cost of the flexibility this distributor needs. D is wrong because that method adjusts premium against values the insured reports periodically. It addresses how premium is calculated rather than how the limit is structured. A distributor with 4 Pennsylvania warehouses has inventory that keeps moving between sites, so insuring each location for a fixed amount forces guessing where goods will sit on the day disaster strikes. Specific insurance assigns a separate limit to each location. So if Allentown holds more inventory than its stated amount, the excess is uninsured even while the other 3 warehouses sit with unused coverage. Blanket insurance applies one limit across all locations, so the full amount stands behind wherever the loss occurs. And the coinsurance test runs against total values company-wide instead of penalizing one underinsured site. Walk the same fire through both structures. Under specific insurance, recovery stops at Pittsburgh's stated limit no matter what sits unused elsewhere, while under blanket insurance the full combined limit responds, same premium, materially different payout. Blanket insurance costs more and requires a signed statement of values, but it delivers a limit that follows the goods wherever they concentrate, rather than sitting fixed at an address the property may have already left. Question 24. A Pennsylvania nonprofit discovers that someone altered the dollar amount on 2 of its checks and forged an authorized signature on a 3rd check drawn on its own account. Which crime insuring agreement responds to losses caused this way? Your options are A. Employee theft, B. Inside the premises, money and securities, C. Computer and funds transfer fraud, D. Forgery or alteration. Got a guess? Lock it in. The correct answer is D. Forgery or alteration. D is correct because the forgery or alteration insuring agreement covers loss resulting directly from forgery or alteration of checks, drafts, promissory notes, and similar instruments drawn on the insured's accounts, and it applies worldwide. A is wrong because that agreement responds to theft committed by the insured's own employees. Nothing in these facts identifies the forger as someone on the payroll. B is wrong because that agreement covers theft, disappearance or destruction of money and securities within the premises. Altering a check is a documentary loss rather than a taking from the building. C is wrong because that agreement addresses fraudulent electronic transfers and computer-based takings of money or property. Physically altering paper instruments falls outside the scope of that insuring agreement. A non-profit finds altered checks and a forged signature during a bank reconciliation. No break-in, no stolen property, just missing money, and property insurance has nothing to say about it. This is exactly what crime insurance is built for. Rather than one broad grant with exclusions, a commercial crime policy is assembled from standalone insuring agreements, each with its own limit. Employee theft, forgery or alteration, theft of money and securities, and computer or funds transfer fraud, each stand alone. And an insured buys only the agreements matching its actual exposures. Forgery means signing another person's name without authority, so the instrument only appears authorized. Alteration means changing the terms, usually the amount, on a genuinely signed instrument. Both must be drawn on the insured's own account, which is the boundary that keeps this agreement from becoming general fraud coverage. Picture the check itself, the written amount changed after signing, and a signature line bearing a name nobody in the organization actually wrote. Both defects sit on paper drawn against the insured's own account, which is precisely what this agreement targets. Identifying the mechanism of loss, not just the fact that money vanished, is what selects the right agreement. Altered amounts, forged signatures, and instruments drawn on the insured's own account point to forgery or alteration, while missing cash points to theft, and a trusted bookkeeper diverting funds points to employee theft. Question 25. A Pennsylvania insurer charges 2 applicants of the same age, in the same class and presenting essentially the same hazard, different homeowners' rates because one of them belongs to a particular ethnic group. Which unfair method of competition does this pricing decision represent? Your options are A. Rebating, B. Unfair discrimination, C. Defamation, D. Twisting. Which one is it? Pause the video if you need more time. The correct answer is B. Unfair discrimination. B is correct because the Unfair Insurance Practices Act forbids discriminating among individuals of the same class and essentially the same hazard and rates, benefits or underwriting standards by reason of characteristics such as race, religion, or ethnic group. A is wrong because rebating means returning part of the premium or giving something of value outside the contract to induce a purchase. No inducement was offered to either applicant here. C is wrong because defamation concerns false or maliciously critical statements about a person's financial condition. The wrong here lies in pricing rather than in anything the insurer said. D is wrong because twisting requires a misleading comparison used to move a policyholder from one company to another. Both people in this example are new applicants. Insurance pricing is discrimination by design. An insurer must charge more where expected losses are higher and less where they are lower, or it cannot survive in a competitive market. The real regulatory question is never whether insurers may discriminate, but which distinctions are legitimate. Legitimate classification rests on a demonstrated relationship to expected loss. Frame versus masonry construction, sprinklered versus unsprinkled, an urban location with heavy theft versus a rural one, a clean driving record versus one with accidents. Each correlates with loss experience and justifies a rate difference. This is the entire foundation of actuarial pricing. Unfair discrimination requires two conditions together. The individuals are in the same class and present essentially the same hazard, yet they are treated differently anyway. Different treatment alone proves nothing, since different treatment is what rating is. Same class alone proves nothing either. The violation is the combination. When a difference exists, with no legitimate rating rationale behind it. Picture a Pennsylvania insurer quoting two applicants in the same neighborhood, comparable frame houses, clean loss histories, the same fire department, the same underwriting class. One receives a higher rate because of ethnic background, even though nothing in construction protection or loss experience explains it. That is unfair discrimination in the statutory sense. The law polices the basis for a distinction, not the existence of one. A distinction grounded in expected loss is classification. A distinction grounded in a personal characteristic unrelated to risk, applied to people already called alike, is a prohibited practice. Question 26. A Pennsylvania insurer accepts an original application for a private passenger automobile policy from a new customer. Which statement correctly describes the statutory notice that must accompany that application and the effect of the applicant's signature on it? Your options are A. A notice of rate filings, B. A notice of assigned risk rights, C. A notice of available benefits and limits, D. A notice of guarantee protection. Take a second. Which answer would you pick? The correct answer is C. A notice of available benefits and limits. C is correct because at original application, the insurer must give a prominent statutory notice listing available first-party benefits and uninsured and underinsured motorists' limits, and the insured signature creates a presumption of actual knowledge of those options. A is wrong because rate filings are made with the department rather than delivered to applicants. The statutory notice is a consumer disclosure about coverage choices, not a regulatory filing. B is wrong because the assigned risk plan serves drivers who cannot obtain coverage in the ordinary market. No document at application waives a tort election, which is made by its own separate form. D is wrong because guarantee association protection may not be used as a sales inducement, and no notice guarantees payment, advertising that protection is itself prohibited by statute. Coverage decisions made when a policy is first purchased often don't reveal their consequences until years later, at the moment of a serious accident, when it's too late to change them. Pennsylvania's Motor Vehicle Financial Responsibility Law addresses this by requiring a prominent statutory notice at original application, listing available first-party benefits and uninsured and underinsured motorist limits. It's not marketing and not a policy summary. It's the one moment the choice is still live. Two features carry the substance. The notice attaches to the original application, since that's where coverage architecture gets set and it must be prominent, or it would satisfy the form of the rule while defeating its purpose. The signature is where this acquires teeth, creating a presumption of actual knowledge that shifts the burden onto the insured at claim time. A signed notice listing the very coverages in dispute is difficult evidence to argue past, which is exactly the point. The presumption gives insurers a reliable reason to take the disclosure seriously rather than treating it as one more form in the stack. This two-part structure, disclosure at the moment of decision paired with the legal consequence for acknowledging it, is what runs throughout consumer protection regulation. For a producer, that means the conversation behind the signature has to be real, not just obtained. Question 27. Two commercial general liability policies covering the same Pennsylvania insured both respond to one occurrence, and each insurer agrees to pay the same amount until the smaller policy is exhausted. Which other insurance method are the two insurers applying? Your options are A. Pro rata by limit, B. Contribution by equal shares, C. Primary and excess, D. Non-concurrency. Before I reveal it, which one do you think is right? The correct answer is B. Contribution by equal shares. B is correct because contribution by equal shares has each insurer pay equal amounts until it has paid its full limit or the loss is satisfied. So the policy with the smaller limit drops out first. A is wrong because that method divides the loss according to the relationship each limit bears to the total insurance in force. Payments would then be unequal rather than matched. So is wrong because that arrangement makes one policy respond in full before the other contributes anything at all. The facts describe simultaneous equal payments by both insurers instead. D is wrong because that term describes policies with mismatched terms, limits, or covered property. It names a problem in coordination rather than a method of sharing a loss. When two policies cover the same loss, something has to decide who pays what. Other insurance provisions answer that in advance, coordinating between insurers without ever changing what the insured actually collects. These provisions coordinate carriers, not claimants, and they never shrink what the insured recovers. The commercial general liability form first checks whether coverage is primary or excess, and only if two policies are both primary does the method of contribution matter. Equal shares means every insurer pays the same dollar amount at each step, so the policy with the smaller limit hits its ceiling first and drops out. Contribution by limits instead has each insurer pay proportional to its share of total coverage, so the smaller policy never carries a disproportionate load. Picture two insurers covering one loss, one with a smaller limit and one with a larger one. Under equal shares, they pay identical increments until the smaller one exhausts and drops out. Under contribution by limits, each pays a steady fraction matched to its own limit from the very first dollar. Identify the method by its mechanics. Equal dollar payments and an early dropout signal, equal shares, while payment size to each policy's limit signal contribution by limits. Either way, the insured is paid in full. Only the split between carriers changes. Question 28. A Pennsylvania rental property owner worries the construction costs are rising faster than his dwelling limit. He wants the amount of insurance to step up on its own at each renewal. Which dwelling policy endorsement accomplishes that for him? Your options are A. Dwelling under construction, B. Residential theft coverage, C. Automatic increase in insurance, D. Personal liability supplement. What's your answer? Commit to one before I continue. The correct answer is C. Automatic increase in insurance. C is correct because the automatic increase in insurance endorsement raises the dwelling and other structures limits by a specified percentage at each renewal, which helps keep the amount of insurance aligned with rising construction costs. A is wrong because that endorsement adapts the policy to a building being erected, requiring the named insured to be the intended occupant. It addresses a stage of construction rather than inflation. B is wrong because theft coverage is not automatic in the dwelling program and must be added separately. It broadens perils rather than adjusting the amount of insurance. D is wrong because that supplement adds personal liability and medical payments coverage to a dwelling policy. It creates liability protection and leaves the property limits entirely untouched. Property values never hold still, and construction costs rise steadily with materials, labor, and code changes. A dwelling limit set accurately today quietly drifts out of alignment within a few years, and nothing in the policy ever announces that drift. Two mechanisms punish an outdated limit. Replacement cost settlement requires the limit to meet a stated relationship to full replacement cost, or losses settle less favorably. Coinsurance imposes its own proportional penalty when the limit falls short of the required percentage of value, turning a fully insured loss into a partial one. The automatic increase endorsement raises the dwelling limit by a set percentage at every renewal, with no request, appraisal, or attention required from the insured. This solves a behavioral problem, not a technical one, since almost nobody reviews their limits on their own, and making the increase automatic changes the default itself. Inflation Guard and automatic increase endorsements attack the problem prospectively, before a loss occurs. Coinsurance and replacement cost conditions penalize it retrospectively after the loss happens. Together, these two halves explain why the endorsement exists at all. The endorsement applies a flat percentage mechanically, while real construction costs can spike after a catastrophe and a renovated or expanded property gains value the percentage never anticipated. Periodic review still matters, because this endorsement reduces the cost of neglect rather than eliminating the need for attention. Question 29. A Pennsylvania adjuster accepts a proof of loss he knows was filed after the policy deadline and continues handling the claim for weeks. The insurer later tries to deny the claim as late. Which pair of concepts prevents that denial? Your options are A. Indemnity and subrogation, B. Adhesion and aleatory, C. Concealment and warranty, D. Waiver and estoppel. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Waiver and estoppel. D is correct because waiver is the voluntary surrender of a known right, and estoppel prevents a party from reclaiming a right it has already given up. So accepting the late filing and working the claim forfeits the timeliness defense. A is wrong because indemnity limits recovery to the actual loss, and subrogation lets an insurer pursue a responsible third party. Neither addresses an insurer's conduct toward its own insured. B is wrong because those terms describe the character of the insurance contract, one drafted by the insurer and one exchanging unequal values. They do not govern claim handling conduct. C is wrong because concealment is an insured's failure to disclose a material fact, and a warranty is a promise about a condition. Both look at what the insured did rather than what the adjuster did. Waiver and estoppel are separate doctrines, but in insurance disputes they arrive together so often that it helps to treat them as a pair rather than two isolated rules. Waiver is the voluntary surrender of a known right. Estoppel prevents the insurer from reclaiming that right once another party has relied on the surrender. One describes giving it up, the other prevents taking it back, and they operate in sequence. Knowledge is the essential element of waiver. A right cannot be voluntarily surrendered unless the party holding it knew the right existed. An adjuster who knowingly accepts a late proof of loss and keeps handling the claim has surrendered that defense through conduct. Estoppel focuses on the insured's detrimental reliance, like weeks spent cooperating with an investigation. But these doctrines have limits. They apply to procedural conditions, not to creating coverage that never existed, which is why insurers use a reservation of rights letter to preserve defenses while still investigating. The practical lesson is simple. Working a claim as though a defense does not exist is exactly how that defense disappears. Question 30. A Pennsylvania insurance producer explains to a client that certain lines of business receive no protection at all from the Commonwealth's Property and Casualty Guarantee Association. Which of the following lines is expressly excluded from that association's coverage? Your options are A. Workers' compensation insurance, B. Homeowners insurance, C. Commercial general liability insurance, D. Personal automobile insurance. Which would you go with? Lock it in before the reveal. The correct answer is A. Workers' compensation insurance. A is correct because the Property and Casualty Association excludes several lines, including workers' compensation, surety and fidelity bonds, title, ocean marine, credit and mortgage guarantee, with workers' compensation insolvencies handled through a separate fund. B is wrong because residential property coverage is a core line the association protects. Homeowners claimants are among the people the statute was written to shield from insurer insolvency. C is wrong because commercial liability claims fall within the association's covered claims, subject to the statutory cap. Excluding them would leave business claimants without any backstop. D is wrong because automobile claims are squarely within the protection, and they make up a large share of what the association actually pays after an insolvency. Insurance regulators can reduce insolvencies, but they can never eliminate them entirely. Every state runs a guarantee association to catch what falls through when a carrier fails. All licensed insurers must belong, and when a member fails, the association pays covered claims up to statutory limits. Funding comes from assessments on solvent competitors, which is exactly why coverage is capped rather than unlimited. Workers' compensation gets its own dedicated fund, and the reason is instructive. Its benefits are statutory, can last decades, and carry no dollar or time cap on medical costs. So folding it into the general fund would distort every other line's assessments. The other exclusions follow different reasoning. Ocean marine and surety insure sophisticated business buyers. Title insurance covers past defects, not future events. And mortgage guarantee and credit insurance carry correlated risk that spikes precisely when a downturn hits hardest. Seeing workers' compensation among the answer choices is the reliable signal that it's excluded. And remember, producers may never sell a policy by pointing to guarantee protection, since that would undercut the market discipline keeping insolvencies rare. Question 31. A Pennsylvania underwriter prices an unusual amusement ride using her own judgment because no published rate exists. Prices a standard retail store from a rate manual and adjusts a trucking account for its own loss record. Which rating method applies to the trucking account? Your options are A. Judgment rating, B. Manual rating, C. Loss cost rating, D. Experience rating. Don't overthink it. Which one feels right? The correct answer is D. Experience rating. D is correct because experience rating, sometimes called merit rating, adjusts an insured's premium up or down according to that account's own claim history, usually measured over roughly a 3-year period. A is wrong because judgment rating applies where no published rate exists and the underwriter must rely on personal experience. That describes the amusement ride rather than the trucking account. B is wrong because manual or class rating uses published rates for defined classes of risk. It treats every member of the class alike and ignores the individual account's own losses. C is wrong because loss costs are pure claims data with no operating expenses or profit included. They are a building block advisory organizations publish rather than a way of rating one account. Every insurance account needs a price, but not every account carries the same kind of information. The industry built several rating methods, each named for the one thing that actually drives the number. Judgment rating relies on an underwriter's reasoning when no published rate exists, like an unusual amusement ride or a marine voyage. Manual rating or class rating uses a published rate for standardized risks, like a typical retail store. Experience rating adjusts a manual rate up or down based on the account's own claim history over roughly 3 years. Retrospective rating sets the final premium only after the policy period ends, based on that same period's actual losses. Schedule rating is often confused with experience rating, but it adjusts a manual rate for present conditions like protection, housekeeping, or employee training, not past losses. Experience rating looks backward at claim history. Retrospective rating looks at the period once it closes. And schedule rating looks at conditions right now. This is why experience rating dominates commercial lines. Manual rating gives an insured no financial reason to improve, since the class rate stays fixed regardless of performance. Experience rating converts safety investment directly into premium savings, aligning the insured's incentives with the insurer's. To identify a rating method, ask what's actually driving the price: an underwriter's discretion, a published class, the account's own history, present conditions, or the closing period's real losses. Whichever input is doing the work names the method every time. Question 32. A Pennsylvania homeowner works as a part-time swimming instructor at a community pool owned by someone else and wants liability protection for that work under her homeowner's policy. Which endorsement extends coverage to activities of that kind? Your options are A. Permitted incidental occupancies, B. Home daycare, C. Business pursuits, D. Personal injury. Got a guess? Lock it in. The correct answer is C. Business pursuits. C is correct because the business pursuits endorsement covers liability arising from certain business activities conducted away from the resident's premises while the insured is working in the employment of someone else. A is wrong because that endorsement addresses a business the insured runs at the resident's premises, such as a studio in the home. This instructor works at a pool she does not own. B is wrong because that endorsement covers a daycare operation run at the insured's home, with premium based on the number of children. Swimming instruction elsewhere is a different exposure. D is wrong because that endorsement adds offences such as libel, slander, false arrest, and invasion of privacy. It broadens the type of injury covered rather than the setting where the insured works. Homeowners policies exclude liability from business activity because business claims differ in frequency and severity from ordinary personal exposures, and pricing personal coverage for business risk would break the policy, but that exclusion is broad. And it catches ordinary part-time work like teaching swim lessons or tutoring, leaving a real coverage gap for everyday homeowners. The business pursuits endorsement closes that gap, but only for a narrow situation: business activity conducted away from the resident's premises, while the insured is working in the employment of someone else, not while owning a business or performing professional services. The employment requirement is the heart of this concept. A swimming instructor employed at someone else's pool fits the endorsement, but the moment that instructor forms a company and enrolls their own students, they've become a business owner, and the endorsement no longer applies. Two exclusions sharpen the boundary further: liability from owning the business and liability from professional services requiring specialized training and judgment. And because the endorsement only covers activity away from home, business conducted at the residence itself falls outside it too, since that raises a separate premises liability issue. The endorsement restores coverage for one specific exposure, being someone's employee doing incidental work away from home, while leaving business ownership and professional services to the policies built for them. Question 33. A Pennsylvania condominium association needs coverage for the building. its own business personal property and the property of others in its care at the premises, while unit owners insure their own belongings separately. Which commercial property form fits the association? Your options are A. The condominium association coverage form, B. The commercial unit owners coverage form, C. The builder's risk coverage form, D. The legal liability coverage form. Which one is it? Pause the video if you need more time. The correct answer is A. The condominium association coverage form. A is correct because the condominium association coverage form insures the association against direct physical loss to buildings, its business personal property, and personal property of others in its care at the described premises. B is wrong because that form is written for an owner of a commercial condominium unit and covers contents rather than buildings. An association needs building coverage above all. C is wrong because that form insures a structure while it is under construction and terminates shortly after completion or occupancy. An established association owns a finished building. D is wrong because that form responds when the insured negligently damages property of others, typically premises it rents. It is a liability coverage rather than a policy on owned buildings. Condominium ownership splits a building into two categories of property, and insurance has to follow that split. Unit owners hold title to their individual units, while everyone collectively owns the common elements through an association. Because no single party owns the whole property, no single policy can cover all of it. The declaration governing the condominium resolves where one responsibility ends and the other begins, and any competent analysis starts there. It specifies whether the association's obligation stops at the bare walls or extends to original installations like cabinetry, flooring, and built-in appliances. Two condominiums across the street can allocate this differently. The condominium association coverage form is the commercial property form written for the association side of the division. It ensures direct physical loss to buildings, to the association's own business personal property, and to personal property of others in its care, custody, or control. Each category corresponds to something the association actually owns or holds. The condominium unit owner's coverage form is the complementary piece, ensuring a unit owner's business personal property and improvements. The association form and the unit owner form are designed to interlock, and the declaration is what makes the seam line up. Read together, gaps are avoidable. The most common failure is entirely preventable. A unit owner assumes the association covers everything inside the unit. Then a kitchen fire damages cabinetry they installed and the claim is denied. Condominium insurance mirrors condominium ownership. So reading the ownership structure first makes the coverage structure follow naturally. Question 34. A Pennsylvania retailer insured under a business owner's policy wants protection against theft by its own staff and against loss of money and securities, neither of which is included in the base form. How does the policy accommodate those requests? Your options are A. Through automatic additional coverages, B. Through optional coverages for additional premium, C. Only by buying a separate crime policy, D. Only by converting to a package policy. Take a second. Which answer would you pick? The correct answer is B. Through optional coverages for additional premium. B is correct because the business owner's form offers optional coverages purchased for additional premium, including employee dishonesty, money and securities, mechanical breakdown and outdoor signs, which extend the base contract without leaving it. A is wrong because additional coverages such as debris removal and fire department service charge are built in at no separate charge. Employee dishonesty and money coverage are not among them. C is wrong because a separate policy is unnecessary when the form already offers these as options. Many small businesses buy them precisely to avoid managing a second contract. D is wrong because converting to a commercial package policy would be a much larger step than this retailer needs. The business owner's form was designed to keep small accounts in one place. The business owner's policy was built to fix a real problem. Small retailers were being served by a system designed for large commercial accounts, wasting time and money on separate forms with gaps between them. The package bundles property and liability into a single form. And unlike a commercial package, business income and extra expense are automatically included rather than added separately. Several other extensions come standard too, on terms that compare well against commercial property forms. Employee dishonesty and money and securities are excluded on purpose because those exposures vary enormously from one business to another depending on cash handling and internal controls. Building them into every policy would charge every insured for risks most don't actually have. The key mechanism is how these gaps get filled, through optional coverages added inside the same contract, not through a separate policy. A separate crime policy brings its own declarations, conditions, and deductible, creating seams where coverage disputes happen, while an optional coverage shares everything with the base form. Think of the business owner's policy as a fixed core with a menu attached. Coverages every eligible business needs are built in, while coverages with widely varying exposure, like employee theft and money and securities, are offered by selection, so premium tracks the actual risk. Question 35. A Pennsylvania surplus lines licensee collects premium on several non-admitted placements during the year and must account for the tax due on that business. Which combination correctly states the tax rate and the annual reporting deadline for that licensee? Your options are A. 3% due by January 31st, B. 2% due by March 15th, C. 5% due by December 31st, D. 1% due by June 30th. Before I reveal it, which one do you think is right? The correct answer is A. 3% due by January 31st. A is correct because Pennsylvania imposes a 3% tax on surplus lines, gross premiums, less return premiums, with a lower rate for risk retention groups, and the licensee's annual report is due by January 31st. B is wrong because that lower rate applies specifically to risk retention groups rather than to surplus lines placements generally, and the filing date stated does not match the statute. C is wrong because the rate stated substantially overstates what Pennsylvania charges, and a year-end deadline would leave no time to compile the prior year's figures. D is wrong because both figures fall well outside the statute. A mid-year deadline would break the calendar year accounting the tax provision is built around. Not every risk fits neatly into the admitted market. When admitted carriers can't write a risk profitably under their approved rates and forms, the surplus lines market steps in to absorb what they won't take. Non-admitted insurers operate outside the state's rate and form regulation, which is exactly what lets them write manuscript forms priced to actual exposure. The trade-off is that policyholders lose guarantee association protection if the carrier becomes insolvent, so access is restricted unless a diligent search shows admitted carriers won't take the risk. Since the state can license and audit admitted insurers, it collects premium tax directly from them. But a non-admitted insurer sits outside that reach, so the obligation shifts to the surplus lines licensee who placed the business. Pennsylvania sets the surplus lines tax at 3% of gross premiums, less return premiums, with the annual report due January 31st. Alongside the tax, the licensee must document the diligent search, attach the required non-admitted disclosure notice, and maintain placement records for the department. The whole framework makes sense once you see it this way. the state can't touch the non-admitted insurer's rates or forms, so it regulates the licensee instead, making the search, the disclosure, the record keeping, and the tax the price of access to that market. Question 36. A Pennsylvania producer places flood coverage through a private insurance company that issues the policy under its own name, while the federal program sets the rates and underwriting rules and the company earns a fee. Which arrangement is the producer using? Your options are A. The emergency program, B. A surplus lines placement, C. The write your own program, D. A difference in conditions policy. What's your answer? Commit to one before I continue. The correct answer is C. The write your own program. C is correct because under the write your own program, a private insurer issues National Flood Insurance Program policies in its own name, while the federal program sets rates and underwriting rules and pays the company an expense allowance. A is wrong because that program is the first phase of community participation before rate mapping is complete, and it caps coverage at lower limits. It describes a stage rather than a distribution method. B is wrong because surplus lines placements go to non-admitted insurers after a diligent search of the admitted market. Flood policies issued under the federal program are not surplus lines business. D is wrong because that specialty property form covers catastrophic perils the underlying policy excludes. It is an alternative to the federal program rather than a way of delivering it. For decades, flood was the classic uninsurable peril in the private market, and the reasons were structural, not a failure of nerve. Flood losses are geographically concentrated, so only owners in flood-prone areas buy coverage, a pure case of adverse selection. When a major event hits, losses become catastrophic across an entire region at once. So private carriers withdrew entirely. Congress created the National Flood Insurance Program in 1968 as a bargain among three parties. Property owners gained access to coverage. Communities gained eligibility by enforcing floodplain ordinances, and the federal government accepted the risk in exchange for those land use commitments. The Write Your Own program separates distribution from risk-bearing. A private insurer issues the policy under its own name, using its own staff, but the federal program sets the rates, the rules, and the policy language, while the company earns an expense allowance for servicing. The private carrier controls none of the terms. It cannot adjust a rate or broaden coverage. Flood insurance works as a public-private hybrid, where the federal program supplies capacity and rules, and private insurers supply the reach. Question 37. A Pennsylvania insured buys a motorcycle and a small motorhome and wants both of them brought under his personal auto policy, since neither vehicle fits the definition of a covered auto. Which endorsement makes that arrangement possible? Your options are A. Extended non-owned coverage, B. Miscellaneous type vehicle, C. Joint ownership coverage, D. Towing and labor cost. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Miscellaneous type vehicle. B is correct because the miscellaneous type vehicle endorsement extends the personal auto policy to vehicles such as motorcycles, motorhomes, golf carts, and all-terrain vehicles that do not meet the covered auto definition. A is wrong because that endorsement broadens liability protection for a named individual who regularly drives vehicles he does not own. It addresses whose vehicle rather than what type. C is wrong because joint ownership coverage adapts the policy when a vehicle is owned by two or more people who are not spouses. Ownership structure is not the obstacle here. D is wrong because that endorsement reimburses towing and roadside labor after a disablement. It adds a service benefit and does not bring new categories of vehicle under the policy. The personal auto policy only pays for damage to a covered auto, and that promise is bounded by a definition most insureds never actually read. A covered auto is a vehicle in the declarations, a newly acquired auto, a trailer the insured owns, or a temporary substitute for a car out of service. Everything on that list assumes a conventional four-wheeled passenger vehicle used for personal transportation. Vehicles outside that definition aren't partly covered, they're simply outside the policy. A motorcycle, motorhome, golf cart, or all-terrain vehicle is not a covered auto, and buying one assuming the policy extends to it creates an invisible gap that only surfaces at claim time. The exclusion isn't arbitrary. A motorcycle has a far higher injury severity with no surrounding structure. A motorhome combines vehicle exposure with occupancy exposure since people live in it, and an ATV operates off-road where traffic law offers no protection. Pricing these into the private passenger rate would misprice everyone. The miscellaneous type vehicle endorsement extends the policy to exactly these vehicles, each described, priced, and underwritten on its own terms. Consolidating brings consistent liability limits, no gaps between carriers, one deductible and claims contact, multi-vehicle credits, and far less chance a seasonal vehicle's coverage lapses. Question 38. A Pennsylvania manufacturer plans to open a facility in a neighboring state within the policy year and wants its workers' compensation policy to respond if an employee is injured there. Which part of the policy addresses that situation? Your options are A. Part 1, Workers' Compensation, B. Part 2, Employer's Liability, C. The Experience Modification, D. Part 3, Other States' Insurance. Which would you go with? Lock it in before the reveal. The correct answer is D. Part 3, Other States' Insurance. D is correct because Part 3, Other States' Insurance, extends the policy to states listed on the information page where the employer may begin operations during the policy period. So benefits are available without a separate policy. Is wrong because that part pays the benefits required by the compensation law of the states already listed as covered. It does not by itself reach into a new jurisdiction. B is wrong because that part responds to employee bodily injury suits falling outside the compensation statute. It addresses the type of claim rather than the geography of operations. C is wrong because that factor adjusts premium according to the employer's own loss history. It is a rating device and creates no coverage in any state at all. A Pennsylvania manufacturer plans to open a facility across the state line, and the benefit obligation that arises depends on the law of wherever the employee is actually injured. If that new state isn't listed on the policy, a gap opens up before anyone notices. The policy has 3 parts. Part 1 pays statutory workers' compensation benefits in states listed on the information page. Part 2, Employer's Liability, covers suits that fall outside the exclusive remedy system. Part 3, Other States' Insurance, is what bridges the gap when the employer expands into a new state during the policy year. Part 1 only responds to states named on the information page. So an unlisted state leaves a statutory obligation with no insurance behind it. Part 3 fixes this. Once work begins in a state listed for that purpose, the policy treats it as though it had been covered under Part 1 from day 1. Part 3 comes with strict conditions. The new work must not have started before the policy period began, since this coverage is for expansion, not undisclosed existing operations. The employer must promptly notify the insurer once work starts, and monopolistic state fund jurisdictions can never be covered this way, because that coverage must come from the state fund itself. Delay in giving notice can leave the employer bearing benefits directly, because Part 3 is a bridge for planned expansion, not a substitute for telling the carrier what's happening. Keep the structure straight. Part 1 handles listed states. Part 3 handles states entered during the term. And Part 2 handles liability outside the compensation system altogether. Question 39. A Pennsylvania producer meets an applicant, reviews the condition of the building, asks about prior losses, and completes the paperwork the company will use to decide whether to accept the risk. Which document is the insurer's primary source of underwriting information? Your options are A. The application, B. The binder, C. The declarations page, D. The certificate of insurance. Don't overthink it. Which one feels right? The correct answer is A. The application. A is correct because the application is the primary source of underwriting information, since it captures the applicant's own answers about the risk, and the producer's role in gathering it is called field underwriting. B is wrong because a binder is temporary insurance issued while a decision is pending. It provides coverage during the gap rather than supplying facts the underwriter uses to decide. C is wrong because the declarations page records the outcome of underwriting, listing the insured, the term, and the limits. It comes after the decision rather than informing it. D is wrong because a certificate of insurance evidences coverage for a third party such as a landlord. It reports what was issued and tells the underwriter nothing new. Underwriting starts with an information problem. The applicant knows the risk intimately, and the insurer knows almost nothing. Every underwriting tool exists to close that gap, and one document sits above all the others. The application captures physical description, construction, occupancy, protection, prior losses, other insurance, prior declinations, and intended use, all in the applicant's own words. Inspection reports, loss runs, and credit-based scores only verify or extend what the application already organized. Because the application is typically attached to and made part of the policy, the applicant's statements become part of the contract itself. That's what gives the insurer a remedy. A material misrepresentation can support rescission during the contestable window, and materiality turns on whether the truth would have changed the underwriting decision or the price. This is field underwriting. The producer walks the property, notices the roof condition and electrical service, asks about losses, and records the occupancy. The underwriter who receives that submission has never seen the building and will decide entirely from what the application says. Careless field underwriting cuts both ways. An application built on answers the applicant never gave can bind the insurer and expose the producer, while an inaccurate answer left unchecked leaves the claim open to rescission. Treat the application as a legal document, not data entry, because everything else in the file is built on it. Question 40. A Pennsylvania firm's claims-made general liability policy expires and the firm does not buy a supplemental tail endorsement. Which protection does the policy still provide automatically for claims arising from events that occurred before the policy expired? Your options are A. Unlimited time to report claims, B. A new retroactive date, C. Conversion to occurrence coverage, D. A basic extended reporting period. Got a guess? Lock it in. The correct answer is D. A basic extended reporting period. D is correct because a claims-made policy includes a basic extended reporting period at no additional charge, giving a short window to report claims and a longer period for occurrences already reported to the insurer. A is wrong because unlimited reporting time comes only with the supplemental tail purchased by endorsement. The automatic protection is deliberately short and limited in the scope it provides. B is wrong because the retroactive date is fixed when the policy is written and marks the earliest injury the contract recognizes. Expiration does not create a new one. C is wrong because trigger types cannot be swapped after the fact. Moving to occurrence coverage requires buying a different policy for future periods rather than transforming an expired one. When harm surfaces years after the exposure that caused it, insurance must decide which policy year answers for it. That decision depends on the policy's trigger, and two triggers dominate the market. An occurrence policy attaches to the year the injury actually happened, even if the claim arrives 15 years later, which is generous to the insured but hard for the insurer to reserve. A claims-made policy instead attaches to the year the claim is made and reported, closing the insurer's exposure cleanly but leaving the insured exposed once the policy expires. Two devices manage that exposure. The retroactive date limits how far back coverage reaches, excluding events before it, while the extended reporting period, or tail, extends how long afterward a claim may still be reported. Every claims-made policy automatically includes a basic extended reporting period at no charge, typically 60 days, or 5 years for occurrences already reported. The supplemental tail is different. It must be requested and paid for, but in exchange it provides an unlimited reporting window for events between the retroactive date and expiration. An insured who skips the supplemental tail is not left with nothing, since the basic period still applies, but it is short. Carrying that distinction forward is what separates a professional who understands claims-made coverage from one whose exposure only becomes visible years later. Question 41. A Pennsylvania jury awards an injured plaintiff her medical bills and lost wages, then adds a further sum to punish the defendant for conduct it found grossly reckless. Which term describes that additional sum awarded beyond her actual losses? Your options are A. Special damages, B. General damages, C. Punitive damages, D. Compensatory damages. Which one is it? Pause the video if you need more time. The correct answer is C. Punitive damages. C is correct because punitive damages are awarded to punish a defendant for gross negligence or willful misconduct and to deter similar behavior, and they go beyond restoring what the plaintiff actually lost. A is wrong because special damages are the provable monetary losses such as medical bills and lost earnings. Those are precisely the amounts the jury awarded first. B is wrong because general damages compensate for non-monetary harm such as pain and suffering. They still aim at making the plaintiff whole rather than punishing anyone. D is wrong because that broader category takes in both the monetary and non-monetary elements of the plaintiff's loss. The extra sum was added for a different purpose entirely. Civil damages fall into categories that serve different purposes, and insurance treats them differently as a result. Let's break down how each type is measured and why that distinction matters so much. Compensatory damages restore what the plaintiff actually lost. Special damages are the measurable out-of-pocket items, while general damages cover real but unquantifiable harms like pain and suffering. Both look backward and try to make the plaintiff whole in money. Punitive damages are categorically different. They punish gross negligence or willful misconduct and deter future behavior. So the measure is the defendant's conduct and financial capacity, not the plaintiff's loss, which compensatory damages already covered. Ordinary negligence alone never triggers them. Picture a jury awarding medical bills and lost wages as special compensatory damages, pain and suffering as general compensatory damages, and then adding a separate sum after finding the defendant grossly reckless. That final sum is punitive, and it corresponds to nothing the plaintiff lost. This is where the concept becomes consequential. Many states hold that punitive damages for a defendant's own conduct are uninsurable, since letting an insurer pay the penalty would erase its deterrent purpose. Other states allow coverage, so a producer must know which rule and which policy language applies rather than assume a definition of damages sweeps everything in. Question for you. A Pennsylvania automobile dealership is insured under the garage coverage form and needs coverage for customer vehicles left for repair as well as physical damage on its own sales inventory. Which pair of covered auto symbols addresses those two exposures? Your options are A. Symbols 1 and 7, B. Symbols 30 and 31, C. Symbols 8 and 9, D. Symbols 48 and 49. Take a second. Which answer would you pick? The correct answer is B. Symbols 30 and 31. B is correct because symbol 30 designates customers' autos left with the insured for service, repair, storage, or safekeeping, while symbol 31 designates the dealer's own autos, including vehicles held for sale and on consignment. A is wrong because those symbols belong to the business auto form, designating any auto and specifically described autos. The garage form uses its own numbering for dealer exposures. C is wrong because those symbols cover hired and non-owned autos on the business auto form. Neither addresses customer vehicles left at a dealership or inventory held for sale. D is wrong because those symbols address trailers held under written interchange agreements in trucking operations. A dealership that exchanges no trailers has no use for either of them. A car dealership has two completely different populations of vehicles sitting on the same lot, and neither one fits ordinary commercial auto coverage. Let's look at how the garage form was built to solve that problem. Symbol 30 covers customers' autos left for service, repair, storage, or safekeeping. Symbol 31 covers the dealer's own autos, including vehicles held for sale or on consignment. Together, they let one form handle both populations instead of forcing them into a policy built for neither. Ordinary general liability excludes property in the insured's care, custody, or control, which would leave a repair shop completely unprotected when it damages a customer's car. Garage keepers coverage exists specifically to close that gap. Legal liability coverage pays only when the dealer is legally at fault. So a tornado-damaged car parked properly produces no payment. Direct primary coverage pays regardless of fault and responds first. Direct excess coverage also pays regardless of fault, but only after the customer's own insurance responds, sitting as a compromise between cost and customer experience. The structural insight to carry forward. A dealership's biggest exposures are vehicles it either doesn't own or can't practically schedule. And the garage form was built precisely because ordinary commercial auto coverage was never designed for either one. Question 43. A Pennsylvania organization provides life insurance and social benefits only to people who join it and take part in its lodge activities, and membership is a condition of receiving any benefit. Which type of insurer does this organization represent? Your options are A. A reciprocal insurer, B. A stock insurer, C. A fraternal benefit society, D. A Lloyd's Association. Before I reveal it, which one do you think is right? The correct answer is C. A fraternal benefit society. C is correct, because a fraternal benefit society provides insurance along with other benefits to its members, and membership in the society is a precondition of obtaining any of the coverage it offers. A is wrong because a reciprocal is an unincorporated group whose subscribers exchange insurance and may face assessments, managed by an attorney, in fact. Lodge membership plays no part in it. B is wrong because a stock insurer is owned by shareholders who receive taxable dividends, and it writes non-participating policies. Anyone may buy from it without joining anything. D is wrong because a Lloyd's Association provides coverage through individual underwriters who accept risk personally, and it is known for insuring unusual exposures rather than serving a membership. Insurers can be classified by ownership and structure, and fraternal benefit societies occupy a category all their own. rooted in mutual aid rather than commerce. Stock insurers are owned by shareholders and operate for profit, while mutual insurers are owned by policyholders. Reciprocal exchanges, risk retention groups, and Lloyd's associations have their own categories too, but fraternal benefit societies stand apart from all of them. A fraternal benefit society must have all three features together. It operates for the benefit of members rather than profit. It has a lodge system with ritual or social activity, and membership is required before any coverage is available. The membership precondition is the fastest way to spot one of these organizations. A commercial insurer sells directly to the public, but a fraternal society requires a person to join and participate first, and only then does eligibility for a benefit certificate arise. Fraternal certificates can even be assessed or adjusted if the organization's finances require it, echoing their mutual aid roots. Whenever a scenario requires joining and participating before any benefit exists, no commercial insurer classification fits. Question 44. A Pennsylvania homeowner adds earthquake coverage to her policy after reading about mine subsidence in the region. A series of tremors damages her chimney over 2 days. How does the earthquake endorsement treat multiple shocks in a short period? Your options are A. Each shock carries its own deductible. B. Only the first shock is covered. C. Coverage applies only to the dwelling. D. Multiple shocks count as one loss. What's your answer? Commit to one before I continue. The correct answer is D. Multiple shocks count as one loss. D is correct because the earthquake endorsement treats all shocks occurring within a stated period, commonly 72 hours, as a single earthquake, so the insured applies one deductible rather than several. A is wrong because separate deductibles for each tremor would leave an insured with almost nothing after a typical seismic sequence. The endorsement groups them precisely to avoid that result. B is wrong because the endorsement covers the whole event rather than a single moment within it. Aftershocks are part of the same occurrence for settlement purposes. C is wrong because the endorsement extends to other structures and personal property as well. Limiting it to the dwelling would leave the contents of a damaged home unprotected. Deductibles apply per occurrence, so counting matters. For a fire, the count is obvious. But for a peril that arrives in waves, like earthquake, the count is genuinely ambiguous. A main shock is typically preceded by foreshocks and followed by aftershocks, sometimes for days, each one potentially weakening the structure a little more. The earthquake endorsement fixes this with a time-based rule. All shocks within a stated period, commonly 72 hours, count as one earthquake, one deductible, and the clock starts from the first shock, not the largest. This device is not unique to earthquakes. Similar occurrence definitions appear in windstorm and hail coverage and in catastrophe reinsurance, because any peril arriving as a sequence needs a rule fixing where one occurrence ends and the next begins. The rule cuts both ways. Shocks within the window save the insured money, but shocks outside it trigger a second deductible. And in Pennsylvania, remember that mine subsidence is a separate exposure entirely, excluded from earthquake coverage and insured through its own state program. Question 45. A Pennsylvania wholesaler's inventory swings widely from month to month, and the owner wants premium to track the actual values on hand rather than a fixed estimate. Which commercial property endorsement is designed for that pattern of values? Your options are A. Peak season limit of insurance. B. Value reporting form. C. Ordnance or law coverage. D. Spoilage coverage. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Value reporting form. B is correct because the value reporting form requires the insured to report values to the insurer on a set schedule and adjusts premium against those reports, which suits a business whose inventory changes unpredictably. A is wrong because that endorsement raises the limit for a stated period each year. It works when the build-up is predictable and seasonal rather than constantly shifting. C is wrong because that endorsement funds the increased cost of rebuilding to current codes after a loss. It addresses construction requirements rather than fluctuating inventory values. D is wrong because spoilage coverage protects perishable stock against temperature or humidity changes. It responds to a specific cause of loss rather than to how premium is calculated. Picture a wholesaler whose inventory triples before the holidays and nearly vanishes by February. Ensuring the peak all year overpays for stock that isn't there most months, and ensuring the average leaves the business badly exposed exactly when the most is at stake. The value reporting form solves this by changing what premium is based on. The insured reports actual values monthly or quarterly, a provisional premium is charged at inception, and the final premium is calculated from what was actually reported. The policy limit is set high enough to cover the peak, so coverage is always there when inventory surges, while premium tracks the reported value, so slow, months cost less. The full reporting clause protects the insurer by penalizing understated reports proportionally, the same way coinsurance penalizes an inadequate limit. If the insured reports 80% of true value, recovery at a loss is 80%, even though the loss falls well within the policy limit. This isn't harsh. It's what keeps reporting honest, since the insurer has no other way to know what's actually sitting in the warehouse. Timing rules reinforce this discipline. Missing the first report caps recovery at a percentage of the limit, and being delinquent later locks the insured to the last values reported. Remember, this form is about fluctuating values and premium that follows them, distinct from blanket insurance, which is about where property sits rather than how much of it exists. Question 46. A Pennsylvania insurer signs a contract with a firm that will supervise its Commonwealth operations as an exclusive general agent. Which requirement does the licensing article place on that arrangement? And how quickly must it be met by the parties? Your options are A. Registration within 10 days of contract. B. Registration within 30 days of contract. C. Approval obtained before the contract is signed. D. No registration is required for general agents. Which would you go with? Lock it in before the reveal. The correct answer is A. Registration within 10 days of contract. A is correct because managers and exclusive general agents must register with the department, with the registration filed within 10 days from the effective date of the contract, and operating in violation is a third-degree misdemeanor. B is wrong because 30 days appears elsewhere in the licensing article, covering address changes and reporting of administrative actions. The registration filing runs on a considerably shorter clock. C is wrong because the statute contemplates filing after the contract takes effect, rather than clearing the arrangement in advance. Prior approval would stall ordinary business appointments. D is wrong because the department tracks these arrangements precisely because such firms exercise broad authority over an insurer's business. Exempting them would leave a significant gap in oversight. Insurance regulation targets whoever actually controls the conduct being regulated, not just whoever holds the insurer's name. That principle explains a registration requirement that many candidates find obscure. Managers and exclusive general agents are the entities that can occupy this role. A manager operates the insurer's affairs under contract, while an exclusive general agent supervises operations and appoints producers within a territory. Either way, real authority shifts to a party that is not the insurer and holds no producer license. When an insurer delegates underwriting, producer appointments, and marketing to this kind of firm, real decision-making authority moves outside the insurer itself. Without a registration requirement, the department would have no visibility into who is actually running these functions. Registration must be filed within 10 days of the contract's effective date, because operations begin immediately and a longer window would let unregistered control run for months. Violating this requirement is a misdemeanor of the 3rd degree. A criminal penalty that signals this filing is a gatekeeping requirement, not a formality. It matters most when the department runs a market conduct examination and needs to know exactly who was running the business. Wherever authority over insurance operations moves to a new party, a disclosure or licensing obligation follows it, because regulating an entity that doesn't make the decisions accomplishes nothing. Question 47. A Pennsylvania property and casualty insurer decides to terminate its contract with an independent agency solely because of the agency's adverse loss experience. Which combination of requirements does Pennsylvania law impose before that termination may lawfully take effect? Your options are A. 30 days to the agent alone, B. 60 days to the commissioner alone, C. Immediate notice to the agency's clients, D. 90 days to agent and commissioner. Don't overthink it. Which one feels right? The correct answer is D. 90 days to agent and commissioner. D is correct because Pennsylvania requires the insurer to give the agent and the insurance commissioner written notice at least 90 days before terminating an agency contract. And adverse experience must span at least 2 successive years after rehabilitation efforts. A is wrong because the statute requires notice to the regulator as well, and the period stated is far shorter than the law allows. Both halves of this answer understate the protection. B is wrong because leaving the agent out of the notice would defeat the purpose of the statute. The agency is the party whose business is at stake and must be told directly. C is wrong because the law does not direct the insurer to contact policyholders about an agency dispute. Notice runs to the agent and the commissioner rather than into the marketplace. Terminating an agency relationship isn't a fair fight. The carrier just loses one distribution outlet, but the agency can lose its entire book of business built over years of client relationships and renewals. Pennsylvania's statute imposes 2 distinct requirements, and keeping them separate matters. One governs notice, meaning how much warning is given. The other governs grounds, meaning what the carrier must prove when citing the agency's loss experience. The insurer must give written notice to both the agent and the insurance commissioner at least 90 days before terminating. That length is calibrated to the real work of remarketing an entire book of business under time pressure. Notifying the commissioner alongside the agent also lets the department spot patterns of carriers systematically terminating agencies across regions or lines. The substantive rule applies only when adverse loss experience is the stated reason. That experience must span at least 2 successive years, and the carrier must have already attempted rehabilitation, discussing underwriting practice, adjusting classes of business, or offering training. A single bad year could be random chance. So the statute treats loss experience as a problem the carrier helped create, not a defect belonging solely to the agency. The rule to remember: 90 days written notice to both agent and commissioner, adverse experience across at least 2 successive years, and rehabilitation attempted beforehand. Pennsylvania regulates termination precisely because that's where the power imbalance between carrier and agency shows most clearly. Question 48. A Pennsylvania physician's professional liability insurer wants to settle a malpractice claim she believes is unfounded, and she fears the effect on her reputation. Which provision found in many professional liability policies gives her a voice in that decision? Your options are A. The retroactive date provision, B. The self-insured retention, C. The consent to settle clause, D. The supplementary payments provision. Got a guess? Lock it in. The correct answer is C, the consent to settle clause. C is correct because a consent to settle clause requires the insurer to obtain the insured professional's agreement before settling a claim, which protects a practitioner whose reputation may suffer from a settlement. A is wrong because a retroactive date sets the earliest injury a claims-made policy will recognize. It governs which events are covered rather than who decides to settle one. B is wrong because that amount is what the insured absorbs before the policy responds. It affects the economics of a claim and gives the insured no say in settlement strategy. D is wrong because that provision funds defense, costs, bonds and related expenses alongside a covered claim. It pays for the defense rather than allocating control of it. Ordinary liability insurers can settle claims without the insured's agreement, because the insurer pays and the insured has no financial stake worth fighting over. Professional liability breaks that logic, because a settlement can look like an admission of error that follows a career forever. A physician, attorney, accountant or architect stakes something no payout captures: professional reputation. In medicine, that stake is concrete. Since settlements are often reported to national practitioner data banks and can follow a doctor's credentialing and hospital privileges for life. The consent to settle clause hands the insured veto power over any settlement. The hammer clause answers back if the insured refuses a recommended settlement. The insurer's liability caps at that settlement amount plus defense costs so far, leaving the insured on the hook for everything beyond. Some modern policies soften this with proportional splits or a reasonableness standard instead of an absolute cap. Here's what that split looks like in practice. The insurer covers the settlement amount and defense costs up to the point of refusal, while the insured absorbs any excess verdict and all defense costs that pile up afterward. Professional liability policies are built around a conflict ordinary policies don't have. The carrier wants the cheapest resolution, the professional wants their name protected, and the consent to settle clause paired with a hammer clause is the market's negotiated compromise between the two. Question 49. A Pennsylvania applicant wants medical benefits well above the mandatory amount on her private passenger automobile policy. Up to what level must the Motor Vehicle Financial Responsibility Law require her insurer to make medical benefits available to her? Your options are A. $100,000, B. $25,000, C. $50,000, D. $75,000. Which one is it? Pause the video if you need more time. The correct answer is A, $100,000. A is correct because insurers must make medical benefits available up to at least $100,000, well above the $5,000 amount every private passenger policy is required to include. B is wrong because that figure is the minimum accidental death benefit insurers must offer. Borrowing it for medical benefits would cut the required availability to a quarter of the statutory level. C is wrong because that amount corresponds to the aggregate income loss benefit that must be offered. Each first-party benefit carries its own required level under the statute. D is wrong because no first-party benefit in the statutory menu uses that particular figure. It falls between recognized amounts without matching any of them at all. Auto insurance regulation hinges on two different verbs, and confusing them is what produces wrong answers. Coverage that is mandatory must be included in every policy, the applicant cannot decline it. Coverage that must be made available is something the insurer must offer up to a stated level, and the applicant may accept, reduce, or decline it. One obligation falls on the insured, who cannot escape mandatory coverage. The other falls on the insurer, who must offer availability but cannot force a purchase. Watching which party carries the duty tells you which mechanism a scenario is describing. Pennsylvania's Motor Vehicle Financial Responsibility Law uses both mechanisms for first-party medical benefits. Every policy must compulsorily include at least $5,000, a floor set low enough to keep the product affordable and keep marginal buyers from driving uninsured. But insurers must also make benefits available up to at least $100,000, so an applicant wanting real protection is never turned away. The availability mandate only works if applicants know it exists, so the law also requires prominent notice of available benefits at application, with the applicant's signature, creating a presumption of knowledge. The offer requirement and the notice requirement are two halves of one design. Either alone would be far weaker. So when a scenario describes an amount every policy must include, think $5,000. When it describes an amount the insurer must make available, think $100,000. Reading whether the obligation falls on the policy or on the insurer resolves it every time. Question 50. A Pennsylvania producer orders a consumer report on an applicant in order to help the company evaluate the risk it is being asked to accept. Which federal statute governs that report, and how quickly must the applicant be notified? Your options are A. Gramm-Leach-Bliley Act 10 days, B. Fair Credit Reporting Act 3 days, C. Terrorism Risk Insurance Act 30 days, D. Motor Carrier Act before issuance. Take a second, which answer would you pick? The correct answer is B. Fair Credit Reporting Act 3 days. B is correct because the Fair Credit Reporting Act governs consumer reports used in underwriting, and notice must be given to the applicant within 3 days after the report was requested, with penalties for willful violations. A is wrong because that statute governs the privacy of non-public personal financial information, requiring initial and annual notices and an opportunity to opt out. It does not set a report notice deadline. C is wrong because that program is a federal backstop for insured losses from certified acts of terrorism. It has nothing to do with consumer reports used in underwriting. D is wrong because that law sets minimum liability limits for interstate motor carriers and requires a federal endorsement. It is a trucking financial responsibility statute rather than a consumer protection law. Before the Fair Credit Reporting Act, agencies quietly compiled files on people's credit, employment, and habits, riddled with uncorrected errors, and used them to make decisions no one ever explained. Congress stepped in with a statute built entirely around transparency. The Act recognizes two categories of report. A consumer report pulls creditworthiness, character, and reputation from records and databases, while an investigative consumer report goes further, gathering information through personal interviews with neighbors, friends, and employers. The statute works by placing obligations on everyone in the chain. Reporting agencies must ensure accuracy, users must have a permissible purpose, and consumers gain the right to see their file, dispute errors, and learn when a report counted against them. For insurance underwriting, notice of a consumer report must reach the applicant within 3 days of the request, so it arrives before the decision, not after. Investigative reports demand added disclosure about their nature and scope, and any adverse action requires notifying the applicant and naming the reporting agency. The principle underneath it all is transparency. Anyone evaluated by a file someone else assembled has the right to know it exists, see it, correct it, and learn when it mattered. And that wraps up today's full practice review. Looking for more practice? Our website has exactly what you need. Just follow the link in the description below. There you'll discover hundreds of free practice questions along with complete, well-organized study guides ready for you to explore whenever you like. So go ahead, click through, dive right in, and start learning today. Subscribe so the next set of questions finds you, and good luck on your Pennsylvania property and casualty insurance exam.